Conception. People often see that big institutions like pension funds or mutual funds hold a massive percentage of all stocks, often cited as 80 to 90% of trading volume in some markets. They then assume these institutions are net buyers who just keep adding to that huge pile. This is incorrect. That huge pile is their inventory, not their daily flow. Their goal is to manage that inventory, not to constantly increase it. The reality: matching buy and sell orders. For every single trade, there is a buyer and a seller. An institutional trader cannot buy 1 million shares of Apple unless another institution, or many smaller traders, is willing to sell 1 million shares of Apple at that moment. Institutional traders fall into two main categories, and both are essential. 1. Asset managers, mutual funds, pensions, hedge funds. Goal: outperform a benchmark or achieve a specific return. They are not directional buyers. They rebalance. They buy stocks they think will go up. They sell stocks they think will go down or have become too expensive. They sell one stock to buy another. Sector rotation. Over a full market cycle, years, their buying and selling volume is nearly equal. Their net buying, as a percentage of their total assets under management, is very small, e.g., from new client cash inflows. 2. Market makers and investment banks, proprietary trading desks. Goal: provide liquidity and profit from tiny price differences. Their business model is pure balance. They stand ready to buy and sell constantly. They profit by buying at a bid price and selling at an ask price. If they only bought, they would go bankrupt in a day. Their whole job is to buy from one trader and immediately sell to another. So why does it look like they're always buying? You see news about a huge institutional buyer stepping in. This is misleading. What's actually happening is one institution is making a large, aggressive purchase. But who is on the other side? Another institution is selling. A pension fund rebalancing out of tech stocks might be the seller to a hedge fund buying them. The trade is institution to institution. The huge buyer is creating the selling pressure. When a fund needs to buy 5 million shares, it doesn't place one order. Its traders spend all day buying small chunks. This constant demand drives the price up just enough to convince other institutions and algorithms to sell into that rising price. The buyer is the reason for the selling. Retail is the other side, but not dominant. Sometimes retail traders are net sellers to a big institutional buyer, e.g., during a panic. But in normal times, institutional volume dwarfs retail. The primary counterparty for an institution is another institution. What about the big percentage they hold? Let's use an analogy of a large warehouse. Inventory. The warehouse holds 1 million tons of steel. This is the institution's assets. Daily flow. Trucks come in and out. 500 tons are delivered, and 500 tons are shipped out. This is daily buying and selling. If the warehouse only bought and never sold, it would fill up in a week. The massive inventory is static, the daily flow is balanced. Institutions have target allocations, e.g., 60% stocks, 40% bonds. If stocks go up, that allocation becomes 65%, 35%. To get back to 60/40ths, they must sell stocks, not buy them. The only times they are net, big percentage, buyers, there are only two specific scenarios where institutions are systematically net buyers over a long period. Net new cash flow. when millions of people contribute to their 401k or pension plans every month, that new cash must be invested. This creates a small, persistent net buy order flow. But this is a tiny percentage of their total assets, e.g., 2 to 3% per year. Share buybacks. When a company, an institution itself, buys back its own shares, it is a net buyer removing shares from the market. This is real net demand. The final verdict. Other, retail, traders, institutional traders. Primary activity can be net directional, hold for years, or speculative. Almost always both buying and selling every single day. Net position over time can be net long, holding, or net short. Neutral. They rebalance, hedge, and provide liquidity. Goal: capital appreciation or speculation. Manage risk, provide liquidity, earn spread, track a benchmark. Key counterparty: often another retail trader or a market maker. Almost always another institution. Conclusion: an institutional trader is a market balancer, not a one-way buyer. Their daily reality is a constant, high-volume cycle of buying and selling. The massive percentage of assets they hold is a static snapshot, not a description of their dynamic, balanced trading activity.